Hello, and thank you for joining us for this second quarter 2024 webinar on LoopNet Search Trends. My name is Brandon Speck, CoStar's National Director of U.S. Retail Analytics. In today's webinar, we're going to focus on 5 key trends that are helping drive the retail industry today and discuss how those trends can be more easily understood using the power of LoopNet search data. The first trend we're going to discuss today is how retail tenants continue to expand footprints throughout the country. Nearly 3,400 store openings have already been announced year-to-date 2024, almost 300 stores more than would have been announced for closures. Now, both of these figures are an uptick from last year, but the positive mix between the two sets the stage for the 4th consecutive year in which openings look set to eclipse closings. We see this same level of interest in the retail market come through when we look at retail search trends on LoopNet. Over 220 million page views were recorded during April of 2024, a new record high, as tenants continue to actively seek out space within the market. Now, as we think about the correlation between tenant search behavior and actual leases signed, we see there is a strong correlation, subject to some lag effect. This makes sense as we think about it. Tenants must first search for and find that space before they can lease it. Given the strong uptick we've seen in the demand for space via LoopNet searches since the beginning of the year, we expect leasing activity will continue to remain robust through the rest of 2024. This would follow up on a very strong first quarter, in which it's estimated that nearly 80 million square feet of retail space was leased throughout the country. This is the highest figure recorded since the end of 2017. And represents the depth of demand within the market today. This brings us to our second trend, the sectors and tenants driving demand in today's marketplace. Overall, just 5 sectors account for nearly 60% of tenant leasing throughout the United States. These include bars and restaurants, discount stores, fitness providers, grocery stores, and education and healthcare providers. These sectors are accounting for a growing share of leasing activity throughout the country. When we look at the largest increase in relative leasing by sector, we see that food services at 19.1% is not only the largest sector, but also at 2.2% growth on a year-over-year basis is the fastest growing sector as well. Other sectors that are increasing their relative share of leasing activity include sporting goods, books and hobby providers, and discounters, which continue to appeal to consumers seeking out value in this high-cost environment. On the opposite end of the spectrum are sectors that are leasing less space today than they did over the 5 years prior to the pandemic. These include grocery stores, fitness providers, and furniture stores, which have been impacted by the slower overall pace of housing sales. While grocery stores and fitness remain a large component of the overall market and a critical source of leasing activity, we've seen their relative share of activity continue to decline here over the last couple years. Now, turning our attention to LoopNet search activity by sector, we see that the sector leading with the average number of views per tenant has been department stores, with nearly 1,000 views per tenant over the first few months of the year. Other sectors that have been heavily searching out space within LoopNet include bookstores, appliances, specialty stores, vendors, and general retailers. Now, honing in on the tenants within the sectors helping drive that activity, we see that by far the heaviest user of LoopNet was Amazon.com, with 1.14 million listing views just in the first couple months of the year. Other large retailers actively searching out space on LoopNet include PetSmart, Target, Nike, Walmart, Posh, and Planet Aid, all of which had more than 100,000 for sale and for listing views on LoopNet just through the first couple months. This brings us to our next trend, limited availability driving more competitive space markets. At 4.5%, the U.S. retail availability rate is hovering at historic lows after years of strong demand formation. Over 95% of U.S. retail markets are tighter today than they were just prior to the pandemic, and most are still seeing availability contract here over the last year. Just a handful of markets today have more than 6% availability, historically what would consider to be a healthy functioning market. Now, strong demand has cut across markets and box sizes, with availability declining across each primary box size as a result. Whether looking over the past year or since the beginning of the pandemic, all box sizes have seen a sharp reduction of available space on market, indicating a more competitive environment. Contributing to current tight space market conditions has been a sharp pullback in new retail supply following the great financial crisis of 08 and 09. Fears of oversupply and disruption from e-commerce led many developers and banks to tamp down on new retail development, and this trend has continued through today. As a result, limited new additions have been added to the retail market over the past decade, helping contribute to today's currently tight availability. Limited new supply additions are expected to continue into the foreseeable future as construction starts, and by extension, the amount of total space under construction has continued to fall with the increase of interest rates and higher construction cost environment. Just under 50 million square feet of retail space was under construction as of the end of the first quarter, the lowest level recorded since the end of 2011. With so little new space available and tenant demand remaining robust, when spaces do come to market, they're filling at a rapid pace. Overall, it's taking just 8.5 months to go from listing on LoopNet to leased with a tenant, which is the lowest number of months on record. Landlords are not only filling space at a record clip, but doing so at much higher rents. The substantial consumption boost and strong demand from tenants in the marketplace has driven retail rents to their highest levels on record, which has allowed for those landlords rolling spaces on 1, 3, 5, or 10-year terms to achieve record rent spreads in today's market. This brings us to our next trend, and that's markets with strong population growth attracting greater interest from tenants. It says that retail follows rooftops, and if such is the case, then retail must be growing very quickly in the Sun Belt. As you see here, most of our fastest growing markets throughout the United States are occurring within the Sun Belt region, with fast growing markets in Texas and Florida, such as Jacksonville, and Austin, or in Orlando, and Dallas, and Houston, all seeing upwards of 1.5% population growth here just over the last year. Strong population growth begets more spending, which drives more retail demand. And that's exactly the dynamic we're seeing play out in today's marketplace. Conversely, high-cost markets along the coast have struggled to retain their populations coming out of the pandemic, with markets such as Philadelphia, New York, and Los Angeles struggling to retain their domestic population. Mirroring population growth trends have been LoopNet search activity, which have also targeted those fast-growing markets within the Sun Belt. Now, while the Los Angeles market, due to its sheer size, stands as a bit of an outlier with over 800 million lease search activities just through the first couple months of the year, most of our other top-performing markets for LoopNet search activity are those seeing robust population growth. These include our South Florida markets, Houston, Dallas, Phoenix, Atlanta, and Tampa, St. Petersburg. Overall, 27 markets across the United States recorded over 100 million search listings through the first couple months of the year, highlighting the depth of tenant demand across the U.S. As I mentioned earlier, there's a direct correlation between tenant search behavior and tenant demand. As such, it's unsurprising to see so many Sun Belt markets outperforming, led by Austin, with 2.5 million square feet of new demand formation just over the last year alone. This equates to an astounding 2% of all of the inventory within the Austin market. Working our way down this list, we see other Sun Belt markets such as Orlando, Miami, Charlotte, and San Antonio, which all continue to attract an outsized share of tenant demand. Conversely, those markets that are struggling to retain their population or have seen a shifting consumer profile have seen much weaker demand formation here over the last year. 6 U.S. markets have seen demand decline over the last year, led by Seattle, with nearly 700,000 square feet of negative demand. Given strong demand gains and limited availability, many U.S. markets are continuing to clip well above average rent gains, led by both Phoenix and Charlotte at nearly 8% over the last year alone. Other fast-growing markets include Tampa, Indianapolis, Jacksonville, and Orlando, each of which have pushed average asking retail rents by more than 6% over the last year. This brings us to our final trend of the webinar. Retail property sales down, but not out. First, the down. After hitting nearly $70 billion in the fourth quarter of 2021, retail transaction volume has fallen back to pre-COVID levels, stabilizing just below $30 billion a quarter. While this represents a sharp decline from prior period activity, we see here that retail property transaction volume has actually held up much better than our other major property types, with multifamily, office, industrial, and hospitality sales all falling by a much larger clip. In fact, for the very first time since 2018, retail actually led of all of the major property types for the most transaction volume in the first quarter of 2024. While property sales have slowed down, property searches remain elevated. Investors viewed over 170 million pages for sale properties in April of 2024, well above historical averages. And those investors are finally finding more inventory available for sale. As for the first time since 2017, inventory on market has risen. In total, over 25 million square feet of additional inventory has been added to the marketplace just here since the beginning of the year. And not only are investors finding more deals on market, but they're finding those deals are starting to reflect today's interest rate reality. After falling to historic lows of just 5.7%, retail transaction cap rates are back up in line with pre-COVID levels at 6.6%. We expect this upward trajectory on cap rates to continue for at least the remainder of the year, providing those investors who are in marketplace with additional opportunities to acquire retail assets at attractive values. And where are those investors looking for value? We see that once again, Los Angeles is heavily targeted, not just by the tenants looking for space, but also the investors looking for properties. Other large markets such as Dallas, Chicago, Northern New Jersey, and Long Island, New York also make the top of the list in for sale searches. However, from a size-adjusted perspective, we see continued interest in a lot of our Sunbelt markets, such as South Florida, Atlanta, and Phoenix, each of which have attracted more than 150 million for sale search views since the beginning of the year. So to recap, retail tenants remain active in today's marketplace, searching for space on LoopNet at record levels. Unfortunately, space is hard to come by, which is putting landlords in the driver's seat in lease negotiations. While capital markets activity was held back by higher interest rates, the market is starting to thaw, with for sale inventory rising and cap rates starting to reflect the reality of today's interest rate environment. Thank you for joining me, and please stay tuned to LoopNet for additional content such as this. Thanks, and have a great day.